Welcome to today's video, where we will be diving into the world of stock market and exploring the top 10 things that affect the price of a stock. Whether you're a seasoned investor or just starting to explore the stock market, it's important to understand the factors that can impact a stock's value. From a company's financial performance to global economic conditions, there are many different forces at play that can affect a stock's price. In this video, we'll take a closer look at each of these factors and discuss how they can impact a stock's value. So, whether you're a seasoned investor or just starting to explore the world of stocks, this video will provide you with valuable insights that can help you make more informed investment decisions. Companies' financial performance, earnings, revenue, and profitability all have a significant impact on stock prices. When a company releases positive earnings results, it is likely that the stock price will increase as investors are more confident in the company's future prospects. On the other hand, if a company releases poor earnings results, the stock price may decrease as investors lose confidence in the company. Economic conditions. The overall health of the economy can affect consumer spending and business investment, which can impact a company's financial performance and stock price. When the economy is strong, consumers are more likely to spend money and businesses are more likely to invest in growth, which can lead to increased stock prices. Conversely, when the economy is weak, consumers may spend less and businesses may be less likely to invest, which can lead to decreased stock prices. Industry trends. Changes in an industry, such as new technologies or shifts in consumer behavior, can affect a company's competitiveness and stock price. For example, if a company is a leader in a new and growing industry, its stock price may increase as investors see potential for growth. On the other hand, if a company operates in an industry that is declining, its stock price may decrease as investors see less potential for growth. Interest rates. Rising interest rates can make it more expensive for companies to borrow money, which can impact their financial performance and stock price. Higher interest rates can also make it more expensive for consumers to borrow money, which can impact consumer spending and ultimately the company's financial performance. Political and regulatory environment. Government policies and regulations can affect a company's operations and profitability, which can impact its stock price. For example, if a company operates in an industry that is heavily regulated, changes in regulations can greatly affect the company's bottom line and stock price. Additionally, the political climate can affect consumer spending and business investment, which can also impact a company's stock price. News and media coverage. Positive or negative media coverage can affect investor sentiment and stock prices. If a company is in the news for a positive reason, such as a new product launch or partnership, it is likely that the stock price will increase as investors see potential for growth. On the other hand, if a company is in the news for a negative reason, such as a scandal or lawsuit, the stock price may decrease as investors lose confidence in the company. Insider buying and selling. Insider trading activity can indicate the company's future prospects and can affect stock prices. When company insiders, such as executives and board members, buy shares of the company's stock, it can indicate that they believe the stock price will increase in the future. On the other hand, when insiders sell shares, it can indicate that they believe the stock price may decrease in the future. Market sentiment. The overall sentiment of investors can affect stock prices, as bullish sentiment can drive prices up and bearish sentiment can drive prices down. When investors are optimistic about the market, they are more likely to buy stocks, which can drive prices up. On the other hand, when investors are pessimistic about the market, they are more likely to sell stocks, which can drive prices down. Supply and demand. The number of shares being bought and sold in the market can affect stock prices. When there is high demand for a stock, the price will typically increase as investors are willing to pay more for the stock. On the other hand, when there is low demand for a stock, the price will typically decrease as investors are less willing to pay as much for the stock. Technical analysis. The stock's historical prices and trading volume and other technical indicators can affect the price of a stock. Technical analysts use charts and other tools to identify patterns in a stock's price and volume, which can indicate whether the stock is likely to increase or decrease in the future. It's worth noting that these are some of the most common factors, but stock prices are influenced by a combination of many other factors as well. This list is not exhaustive, and other factors such as natural disasters or pandemics, political and social unrest can also greatly affect the stock prices. It is important to keep in mind that past performance is not necessarily indicative of future performance. It is always important to conduct your own research and consult with a financial advisor before making any investment decisions. Thanks for watching, and be sure to subscribe for more financial and investing content.